But you have all these various coverages that are built into most third-party coverage of any kind of decent quality cyber policy. So you have network, data, and privacy insurance clauses. The big issue with these insurance clauses, and not everyone's insurance policy is created equal in this respect, is do you get liability coverage only if there's a hacker? Or can you get liability coverage where data is exposed either from a hacker, or on the flip side, someone just makes a mistake in how they collect, gather, or host information. And so I would argue, and I don't know, Mike, if you have a view on how available that coverage is, how expensive it is, but there's lots of lawsuits these days laying the blame at policyholders' feet, saying, you've collected my data improperly, you didn't disclose what you were going to do with the data, or you're tracking my every online movement, and that is a violation of my privacy. What do you see in the insurance world these days with getting coverage for privacy claims where you don't have a hacker?
Yeah, that was a nice tee up. So I'd say two of the bigger issues that we're facing now is the restriction on what we call wrongful collection coverage, and under privacy law, companies need to have certain criteria in order to collect data, and if they do that properly, or they collect data on minors or certain groups of people, they actually have a leg to stand on to bring suit against that company. And in the past, insurance companies were willing to defend and indemnify those impacted individuals. Now that coverage is starting to get restricted. I think to Josh's point, when you think about the differences between first-party and third-party coverages, especially with regards to just catastrophic loss, to your point, ransomware is very acute, it feels very personal, but when you think about the big settlements and the big fines being assessed, especially out of the EU, the third party certainly wins in terms of that cat loss scenario.
I think one of the things I've seen, though, kind of at that point, is that a lot of policyholders are able to get these state consumer privacy endorsements added to their policies. So they may not actually be able to get full coverage for certain portions of their claim, but they'll certainly get their defense expenses for those. There's a potential for coverage for money that has to get put into a fund to compensate some of the victims of these cyber events. But Josh, you may talk about this a little bit, like GDPR, right? A lot of policies started adding GDPR endorsements, and now because we've got BIPA, which John and Jamie's panel talked about briefly earlier, we have the California Consumer Privacy Act. Because of the proliferation of cases under those and kind of sort of following the GDPR model, we're starting to get these endorsements that are added to these policies.
Yeah, I had one more thing. Again, the conversation on wrongful collection coverage is a different category, but process is key here, and making sure if you're a policyholder, you're educating the underwriters on your key cybersecurity controls is important, because something like metapixels, which is a tracking technology, it's called metapixel because it's literally a pixel on a website that tracks consumer movement on a specific web page. If a company is able to show that they have processes in place to make sure they're not collecting data wrongfully, if there's a human in the loop procedure, that coverage restriction actually gets removed from the policy, which is advantageous. So, a huge restriction to coverage can easily get removed if you just have the appropriate conversation.
And truly no assumptions about what cyber insurance covers or excludes, just because so many of the insurance products are different. There's really very little uniformity of products. And perhaps just as importantly, we're seeing some insurance companies take hyper-aggressive claims positions, denying claims. So we've seen one insurance company basically denying coverage for a cyber claim. Basically, it's a tracking claim, kind of pixel tracking, and the insurance company is arguing that's subject to a wiretap exclusion. And that wiretap exclusion's been in the policy forever, and it's totally for a different purpose, and that's not stopping the claims department from trying to deny the claim in its entirety. And so again, you get into some of this language which might be gratuitous and it's just redundant of the protection you already have. So the GDPR coverage. If you have regulatory coverage and no boundary for where the lawsuit has to be brought, a lot of these policies are global, worldwide, say for maybe a few jurisdictions, you don't really need the GDPR endorsement, but it's nice to have, right? A clarification of coverage. But, and we'll talk a little more about sublimits in a bit, but just remember too, if they give you that endorsement for coverage you already have, and then it's also suddenly subject to a sublimit, it's really almost like an exclusion, right? You're losing, half your blanket limits. So do keep in mind, sometimes the exclusion is masquerading as an endorsement that promises some level of coverage. So again, reading every line, working with a very seasoned insurance broker, not a bad idea at all. Do you want to talk a bit about multimedia coverage and IP and how it might fit with like tech, or?
I'm happy to, because media is kind of the ugly stepchild of the cyber policy. It was once upon a time, and it still is, but for most companies, it's just a coverage extension that's slapped onto the cyber form. What we're seeing in the current media space now, which protects typically libel, slander, personal injury, copyright, is that there's an increased amount of IP litigation, especially with AI, right? Everyone is allegedly stealing someone else's data or someone else's IP to train their own models, and it's producing content that doesn't have the appropriate permissions to do so, whether that's music or someone's name, image, likeness. And these types of suits can be pretty costly, especially just given the proliferation of content. I think I saw a stat the other day that every single day, YouTube gets about 50,000 videos uploaded to it, and if you cascade that over a year, the amount of videos that have a certain song being used or a celebrity's, again, name, image, likeness is pretty astronomical. And, since most of the big content, the pictures, the music and whatnot, are owned by individuals with a lot of money to deploy, these types of claims are pretty costly.
And I'll just say a quick word on PCI coverage, which is payment card industry. It's kind of a first-party coverage. It's kind of a liability coverage. I won't spare you the gory details because we've litigated it heavily in a case called Retail Ventures. And so that coverage is important. It does get sublimited for a lot of policyholders. I don't know if that's true across the board. But again, if you're potentially liable to the card brands, and believe you me, those contracts are very one-sided, so the card brands will lay off the liability for sure on any retailer, even sometimes against the merchant banks too, where it will kind of be at a disadvantage for fighting who's got responsibility when the fraudulent card charges come in the door, in addition to all these other administrative expenses and assessments and fines. Very important coverage to have, and needless to say, if it is an exposure for either your organizations or for the clients you advise, really, really good to get the highest limit you can, because with a lot of theft of PIN card information, that is by far the largest line item in the damages. And let's talk a little bit about just kind of the heightened risk of claims. I don't want to step on the shoes of the excellent AI and biometrics discussion we heard earlier today. But do you want to talk a little bit, Dennis, about kind of the heightened tailored attacks? This is not, the email anymore of a guy from a continent away who's a prince and wants to give you $10 million, right? It's something different now.
It's something much, much different. And yes, we talked about some of this, our other panels have talked about this. Just in particular with the use of AI and the accelerated use of AI, we're seeing a lot more speed, volume, scope, and sophistication of these attacks. They're getting much harder to detect. In a lot of cyber events in the past, you had somebody who would work their way into their system and they would sit there for a while and they're very patient. They would sort of track patterns within the organization, and sometimes it can take years. These people will be living in their systems. Now with AI, you have technology that's going in and scraping a lot of historical data and pulling it off and synthesizing it and then creating these very genuine, very realistic deep fakes, other social engineering attacks that, especially in this day and age when we're all moving quickly, maybe not paying attention to a text message or to an email, clicking on downloads, we're putting all of our data at risk. Jamie O'Neill, who spoke earlier, actually did a training seminar in our office a couple of weeks ago, and she put up examples of AI, and we like to consider ourselves smart, very educated, we're paying attention to what's going on, and a lot of the images trick us. There are some that are obvious, but as the sophistication is morphing and getting more sophisticated, we are we've got to be very careful, all victims of that.
You probably all heard or remember the story, I think from late last year, about a video call. It was either the CFO or the CEO. He wires $25 million, and it was a video call with 7 people with only one real person, him, and everyone else is a deep fake. So it is really believable, and I think with AI, those attacks are going to become more and more believable. So the old thing of like, okay, wave your hand, stand up, turn around on the camera, try and see if it's an AI image. I'm sure that AI will be good enough to trick just about any savvy user of Zooms and Teams calls and the like, and probably a point, right, where we'll need AI tools to combat AI tools. So anyway, the battle of the robots. So real quick on malware triple whammies, the only thing worth noting here is malware once upon a time, when you think about the 2017 summer attacks on the National Health Service in the UK and some large pharmaceutical companies and a large food global company, those attacks usually were a kind of one direction catastrophe, which was, it was a first party loss, humongous business interruption, hardware fried, midware, software, data offline, all of those things. Now, most sophisticated malware has the ability not only to encrypt your system, shut you down, demand a ransom, but it also exfiltrates data. So now, what used to be a first-party risk is now a first plus a third-party risk, because the data exfiltrated is probably going to lead to one or many class action lawsuits, plus, of course, regulatory action, state AGs filing because their constituents' data was caught up in all of it. So the malware risk today, ironically, you may not pay the ransom, you may end up paying on the third-party side when you have the class action litigation that we've discussed. And this slide I'll go through just real quickly. Home Depot was an interesting hacking event. It's several years old, but it's a great lesson because Home Depot was both a class action privacy litigation case, it was a first party loss case, and it was a directors and officers derivative shareholder litigation case. Interestingly, Home Depot was able to beat the shareholder litigation against it, yet it still paid over 7 figures in the class action attorney's fees, plus corporate governance. I don't know, like 37 different things they were going to have to redo and revamp and change their whole governance when it came to cyber. And that's a case they won at the district court level. So that just goes to show you how expensive these claims are, even when you're legally victorious. So
And they spend billions in the insurance coverage side as well.
exactly. So it's just these claims now. Any serious breach is probably a multifaceted loss and damages event for certainly larger organizations. Let's switch gears to kind of the state of the cyber market as it exists in 2025. Mike, you want to take us through a little bit of the good and the bad?
Yeah, and I'll try to go quick, just being mindful of timing. But so there's some good news and some bad news. And actually, we met with some carrier leadership earlier this morning, and the general consensus is that 2026 is going to look pretty similar to 2025 from a rate perspective, right? So pricing should be still in a soft space. Carriers are still looking to compete against each other, and from just functionally a renewal perspective, the more competition you have, on the table, the better the outcome is in almost every instance. So rates are expected to be a slight decrease, flat in 2026. Now is also the time to take advantage of that market competition and push for coverage enhancements. Unfortunately, if the market does go hard in 27, 28, carriers are going to be much less willing to have those in-depth coverage extension conversations. So, now is again the time to really hone in coverage, pay attention to it. I think some of the headwinds and the claims we're seeing, and this is actually the bad news, is you might be saying, well, hey, if every week I'm learning about a new breach that's costing hundreds of millions, if not billions, then how come the cyber rates are so competitive? It's really the competition amongst the insurers. They feel like they've got their underwriting models locked in and they're trying to remain profitable, but ransomware is top of mind, and I think business interruption coverage is going to be a bigger focus going into next year. There's certain coverage qualifiers with regards to when coverage stops, whether the network is restored to the state it was pre-breach or if the business was, and there's a big difference between those. And then I also think from a liability perspective, like Josh and Dennis were mentioning, unfortunately attorney costs are going up, class actions are becoming more harsh. Regulators are certainly gaining their confidence both in the EU and domestically, and with the new privacy law coming down the pipeline every month, it seems like. It's just going to get way more complex for companies to stay on top of that. And I'd say the one final thing that I think Willis as a firm is paying attention to is specifically punitive damages and the insurability of them. And if they're not insurable here in the States, how can you get that coverage? There's always insurance for something. There's opportunities to get coverage for that outside of the U.S. markets, and it's something to look into.
The only thing I'll disagree with you there, Mike, is the fact that attorney rates going up. I would consider that unfortunate.
So switching gears to underwriting tips, I think, Mike, this is probably something for you to kick off with, but I remember when what I'll call kind of the modern cyber products was unveiled and started really getting traction. The underwriting to get that was super limited, 2-page application, and half the questions were, name, address, how many employees do you have. I think the underwriting, from what I understand at least, has gotten more rigorous. Do you want to kind of talk to how policyholders put themselves in the best position come application time or renewal time to maybe get a good policy with a decent price?
Are you saying people don't like completing insurance applications? So there's certainly a disconnect between how underwriters use cyber risk and ultimately who completes these applications, which sometimes it's the risk manager, but more often than not, it's the CISO in their office, right? So when you think about highly technical individuals who live and breathe these very niche specialties within the IT world, trying to answer questions of, do you have X control, yes or no? There's going to be a disconnect there because, unfortunately, the responses to almost every single one of these questions is they're highly nuanced. So I think this is an opportunity for the insurance industry to, get up to speed with how CISOs and their teams actually think about protecting their company if they want to underwrite better. That being said, just given the fact that, again, we're in a relatively soft market, if you're completing, I've seen applications in excess of 400 questions. If you're still doing that, it's very outdated. It's something that your broker should try to go away from. And unfortunately, the more questions that you answer where you're forced into a yes or no response, it ultimately gives the carrier more opportunities to deny a claim. And we've seen that, we've been successful navigating that, but why go through the headache when your broker can just eliminate the question altogether?
Yeah, and it's going to that point, not only is the insurance company potentially going to deny coverage, it actually may rescind the policy entirely and just take the policy's void from the very beginning. One of the things that you also have to do when you're submitting your application is you have to attest to the security controls that you're using. And a lot of policyholders will just go ahead and do a self-verification of it. Sometimes ask the broker, yeah, that's fine, go ahead, just check the yes box. I'm using multi-factor authentication. Yeah, you don't fall for that. But the fact is, maybe in a situation like that, if you actually want to have somebody come in and do self-authentication, because all those things that you can do to help yourself during the underwriting, but also then on the claims end, a lot of that's going to be required anyway, depending on the industry. Or it's kind of kill two birds with one stone, in the sense that, like, if you were a bank or you're an insurance company, you're in the financial services industry, you're required to have multi-factor authorization. So do all that. Just pay attention to what your regulations are, and then this way, when you're filling out your application, you can very easily do that. But yeah, to your point, anything that an insurance company can do to latch on to any kind of mistake in an application, they will do that. And in New York, sometimes an innocent mistake can potentially void coverage. So if you actually check the wrong box, you're going to have to wade through that coverage fight.
Oh, no, sorry, again, it's logical. I mean, I went through this with a recent client of mine where they had completed an application for more than a decade. And in the past 5 years, it was the exact same application every single year. So I said, all right, guys, let's think about this. What value is the underwriter going to get out of the 6th version of the exact same application? This is only hurting you. It's wasting your time. It's wasting your CISO's time. And we actually delivered a pretty sizable decrease in premium and some coverage extension. So, taking it, again, outside of the big, scary IT world, it's focusing on the business and ultimately relying on the relationships that you build with your underwriters before there's a claim, before there's a renewal. It almost always works to your advantage.
And for those mid and smaller size policyholders that perhaps don't have quite the leverage to forego the more fulsome application, just really important to make sure that the insurance application is answered in a way that reflects the actual way a policyholder computes. So I think there's almost no individual, probably at an organization of any size other than a one-person shop, that can answer the applications by themselves. They really need to do this in tandem with the risk department, with the treasury department, with their IT group for sure, because we do see the insurance applications, and even the ones that are scaled down. I mean, my jaded view is those applications are deliberately made to be overly broad, vague, and ambiguous, a total trap of the unwary, so that the claims person can grab that, not even talk to the underwriter about their intent with selling their coverage, and then use that as a gotcha moment to negotiate a big haircut off of the claim amount that they're willing to pay on the side of the claim. So if you take that tool away from the insurance claims department's arsenal, you're much better off. And I think if you see lots of yes/no check boxes, you shouldn't be checking either of them. It should be asterisk, see attached, and then explain it, because almost every question is asking for an answer that's probably a lot more nuanced than, start yes or no reply. And I think that kind of segues into just how you approach this, and this is, again, not the broker's point of view or the underwriters, but just at Anderson Kill, seeing all the pressure points of these policies, all the gray areas, all the disputed claims, is a lot of this comes down to a very dynamic insurance market where everything is in flux. So I think at any given time, you have somewhere between 60 and 70 different underwriters wanting to write primary insurance coverage in the cyber marketplace. A lot of them come and they go, and new ones enter the market, so there is the competition, but a lot of this is kind of changing and morphing, and simultaneously what's also changing are all the attack vectors, and now with the advent of AI, that's going to be accelerated all the more. So that's another dynamic event. And then further to that is the fact that almost every insurance underwriter, even if they've been in the game for a long time, they are changing their forms up every 3, 4, 6 months. So that's also a work in progress. And then beyond that, a lot of those same underwriters also offer various versions of coverage, right? They've got the Cadillac version, the Eldorado version, the Ford Pinto version, which you want to avoid. So you've got kind of all these options in the marketplace, which is a long way of saying you really need a seasoned insurance broker by your side, comparison shopping for you, and then you probably need your own internal knowledge base, like your IT people, to match the insurance coverage up with the way that the computing is actually done within the organization. So almost everybody is in the cloud now, at least to a good extent. Once in a while, we'll still see a cyber form that doesn't recognize cloud computing in the base form. And you can get it if you ask the insurance company. I don't think it's additional premium these days unless there are crazy circumstances, but you actually have to know to request it, to get it, to have your form modified. So that is another consideration on this. And when you're looking at appropriate coverage limits, Mike, again, I think this is for you, how do policyholders benchmark and figure out what they need and what they can afford?
Yeah, so the two most common routes to answer that and how companies think about limit adequacy is pure benchmarking, right? Seeing what similar companies purchase, and then also more bespoke company-focused analytics. Pure benchmarking is simple. It's good for a board-level discussion, just to pulse check what you're doing, but the pitfalls of over-relying on pure benchmarking is, especially in the current landscape, there really is no such thing as a true peer. Every company, even if they're in the exact same sector, geography, you're trying to do things differently, and if you rely on what the guys down the street are doing, you're not going to be thinking about what you should be doing. So that's why we try to focus more on the company-specific analytics. And at Willis, we have those analytics in-house, but if you're working with a broker who doesn't, typically they rely on vendors to just have that analytic model outsourced. And usually the inputs for those models is the company domain, so they can get a sense of what potential holes are at the the network and the website and the domain level, as well as revenue, industry class, and the geography where those revenues are derived from. And from there, you think, okay, now I know exactly what my risk is, but in the current landscape, and we saw this with AWS a few days ago, vendor risk is at an all-time high. And if you're a large and complex company, you might have 1,000 different vendors you're working with. And you might think, okay, I purchase a cyber policy, they purchase a cyber policy. If they go down or if they cause a breach, their policy is going to cover us and we're good. The reality is if the big vendor goes down, even AWS in a big way, their insurance program's gone in a second, and you're going to be left paying for it yourself. So.
AWS go down? And Dennis, do you want to talk about time-sensitive clauses that you see in at least some of these policy products?
Yeah, so one of the pitfalls you want to avoid when you're looking at it is just make sure that you're calendaring these dates that are going to be contained within your policy. First of all, there's your proof of loss. We've seen proof of loss dates that are as little as 90 days. One of the larger insurance companies out there in the space, I don't know out there by name, but they give you 6 months, which in the throes of a cyber attack that may be going on for a little bit of time, but is very complex in the investigation and having your forensics figuring out exactly what might have been stolen or locked down or what your business interruption loss might be. 6 months might not be enough, so you're going to see if you can get that extended. But another big point here is the suit limitation clause. In New York, you have 6 years from the breach of the contract to file an action against the insurance company if there's a problem. A lot of the cyber policies that we're seeing actually goes ahead and limits that, and in some policies it's as short as 1 year. So you really, when a cyber event happens, we didn't quite get into like some of the incident response plans, but one of the things your incident response plan should have is deadlines for when you have to take certain actions under your insurance policies.
And just to that end, most serious cyber events these days will probably trigger coverage under more than one policy, so you shouldn't just think, oh, it's a cyber event, so only my cyber policy applies. You may need your D&O coverage, you may need your E&O coverage, you may need your commercial crime coverage, and we haven't really touched upon computer crime coverage, but almost all of those policies promise computer fraud coverage. The limits are usually significant under those policies. The commercial crime insurance companies almost always fight any claim under them for a cyber theft. In those policies, you are looking at a suit limitation clause of, like Dennis said, maybe as short as 12 months, typically 2 years. If you have a property insurance claim, like National Inc. Had, that's usually a 2-year suit limitation under an owner's property policy. So just keep in mind that giving notice often and early across the board protects you down the road, because sometimes it takes months before you really know the lay of the land, what your buckets of damages are, how high is the moon, and all of those things. So we are going to stop here. Thank you very much, everyone, for attending not only this session, but staying with us throughout the day. And Diana, do you want to close us out?
Well, sure. I think you got to close this out, Josh. Thank you for that amazing panel. That's fantastic. Thank you, everybody, for spending the day with us. I hope you learned a lot. I hope you have questions, because we will be making our way towards some cocktails and some hors d'oeuvres, and we would love to speak to you. So I think you've been sitting and listening long enough. Please join us for some refreshments, and thank you again for being here. We appreciate it. Thank you.